typically you can't take personal losses, except there is an exception for casualty and theft losses. Now, if you are here to get a little bit more information about disaster relief, please check in the information box below, and there will be information specifically for the type of loss that you have incurred. You can then skip forward to that particular section of the video. But for those who are interested in learning about casualty and theft losses in general, the rules regarding them, the calculation for them, as well as examples, let's get started. Typically, individuals may only take losses as prescribed by Congress, and under Internal Revenue Code section 165C, an individual may deduct the following types of losses: losses incurred in a trade or business. For example, business losses of a sole proprietor or the sale of a business asset at a loss. You can also deduct losses incurred in a transaction entered into for profit. So, the sale of an asset used in a rental activity that was sold at a loss would lie under this type of loss. And then lastly, you can take losses caused by fire, storm, shipwreck, or other casualty, or by theft. This includes a residence damaged in a hurricane. So losses on personal property typically are not deductible. These are things like you sell your car at a loss when you purchased your RAV4 right after graduation and they just came out with a new model the next month, so you took a depreciation hit of $12,000. Yeah, you cannot take that loss as a deduction. Learned that the hard way. Other personal property includes furniture or your residence. Now, under that one particular type of loss, losses caused by fire, storm, shipwreck, or other casualty, we want to define what an other casualty means. These are events similar to a fire, a storm, or a shipwreck. These can include accidental losses, but the loss must result from an event that is, number one, identifiable, two, damaging to property, and is sudden, unexpected, and unusual in nature. So examples of these include auto accidents, mine cave-ins, sonic booms, whatever those are, and vandalism. If you're going to attribute one of these other casualties to weather must be unusual and severe for a particular region. And auto damage must not be a result of the taxpayer's willfulness or willful negligence. So now let's go over a case to kind of illustrate what's going on here. In fall of 1963, after assisting his wife, quote, in alighting from their family automobile, obviously this is in the 60s, the husband accidentally slammed the door on his wife's hand. Her $1,200 1.38 carat diamond engagement ring absorbed the full impact of the blow, which broke two flanges of the setting holding the diamond in place. Because of this, once they discovered the diamond was dislodged within moments of this accident, an intense search was launched, which continued for weeks. Initially, a human chain of 5 of the White children, White being Agnes White's children, was formed, and they combed intensively their 40-foot area of driveway, as well as part of the adjoining lawn. Additionally, the driveway gravel in the immediate vicinity of the car was raked and put through a sieve. The search continued in a less intensive manner even after the snows came. Petitioners were even still looking for the stone even at the time of trial more than 3 years later, but unfortunately all of these efforts were unsuccessful and the diamond was never recovered. So they took a loss on their tax return in 1963 as a result of losing this diamond from the diamond ring. And the court held that the slamming of the automobile door upon the wife's ring and the resulting loss of the diamond entitled the petitioners to deduct the diamond's loss as a loss arising from other casualty. Well, so why is that? The event was identifiable. They could definitely tell when the diamond was dislodged from the diamond ring and was lost. They also knew that it was damaging to the property. That diamond ring, without a diamond, does not have the same sort of value, and the incident where the casualty occurred was sudden, unexpected, and unusual in nature. It's not usual for you to slam a door upon a diamond ring and then the diamond to be dislodged and never to be found again. It just never happens. There are some events, though, that are not treated as casualties. These are events that have progressive deterioration, such as erosion during wind or rain. Erosion is not sudden. They're not like the floods in St. George, Utah. They're not sudden. Disease or insect damage also. So in instances where there's termite damage that can be proven to have occurred over years, that is not a casualty. Additionally, the decline in value rather than an actual loss of property is also not a casualty. So my RAV4, for example, would not be treated as a casualty, even though it felt like one for me. Other examples include home value as a result of a landslide that destroyed neighbors' property. However, flood damage would be considered a casualty, but the decline in market value due to property in a flood-prone area would not be considered a casualty. Now let's define what theft losses are. Theft includes larceny, embezzlement, and robbery. It does not include misplaced items, as in the case of Mary Frances Allen. Mary Frances Allen, the plaintiff, visited the Metropolitan Museum of Art on Sunday, January 21st, 1945. Sometime in the 2 hours that she was at the Met, her butterfly brooch that she was given by her husband and was valued at $2,400 became detached from her dress. She realized this before leaving the museum and notified a guard and searched the rooms in which she had been in. She notified the jewelry store at which the brooch was purchased, and they put a notice in the New York Times and the Herald offering a $200 reward. Additionally, plaintiffs also filed a police report for the missing brooch, and the police handled the matter as a lost property case. Now, does this sound like theft? And the answer is no. And the court held that the taxpayer, or Mary Frances Allen, had to prove by a preponderance of the evidence that the item was stolen in order to deduct the value of the item as a loss for theft purposes, for the casualty and theft loss rules. However, now the question becomes, could she have taken the loss as a casualty loss? And the answer is no, because having the brooch drop from her dress was not sudden, unexpected, and unusual in nature. People lose items all the time. So the fact that it wasn't a sudden or unexpected thing, such as in the case of the husband slamming the door and it hitting the flange and the diamond on the diamond ring popping off, that's different here than this case where the brooch just fell off of her dress, and as a result she was not able to take the $2,400 as a loss deduction. Theft losses are deducted in the year of discovery, not necessarily in the year of the theft. But no deduction is allowed if you fill out an insurance claim and there is a reasonable expectation of recovering the adjusted basis of the asset from the insurance company. You can't double dip. So had Mary Frances Allen filed an insurance claim and she was able to get $2,400 from the insurance, she would not also be able to take a theft loss if that had been something that she was able to do, because you can't double dip. She didn't actually incur a loss at that point, insurance took over. Now what about partial recovery? If in the insurance claim you receive a portion of what the value of that asset was when you purchased it, then you would be able to take the difference between the amount that you paid for the item and the amount that you received as insurance from the insurance claim. Now let's talk about when you can deduct casualty losses. Casualty losses are deducted in the year of loss. You do not receive a deduction if you file an insurance claim and there is a reasonable expectation of recovering the adjusted basis of the asset from the insurance company. Your adjusted basis being what you paid for it minus any depreciation and including any additions or improvements that you've made to that property. You can receive partial recovery if the insurance settlement recovery is less than your adjusted basis. If a taxpayer, however, receives reimbursement for a casualty loss sustained and deducted it in the previous year, an amended return is not filed. Instead, a taxpayer includes the reimbursement in gross income when it is received to the extent the previous deduction resulted in a tax benefit. So to explain this, let's go to an example. Mike had a deductible casualty loss of $4,000 on his 2016 tax return. Mike's taxable income for 2016 was $60,000. In May 2017, Mike is reimbursed $2,500 for the prior year's casualty loss. So what are the tax consequences? Mike has to include the $2,500 in income for 2017. Why is that? Because in 2016, the $2,500 casualty loss had a tax benefit for him in 2016, and as a result, he has to include that income in 2017. Let's go to disaster relief and talk about this for just a minute. If the President of the United States declares a disaster area, an exception to the general rule regarding the time of the deduction occurs. The taxpayer at this point may elect to treat the loss as having occurred in the taxable year immediately preceding the taxable year in which the disaster actually occurred, so as to provide immediate relief to disaster victims in the form of a refund or in the form of accelerated tax benefits. So here you would amend your tax return and take a loss in the preceding year for a tax refund. And the loss that you would attribute to your prior year tax return is the difference between your insurance settlement and the damages incurred. So, for example, Martha's home was damaged when Hurricane Ike caused an oak tree to fall onto her house. The amount of her uninsured loss was $7,000. She received $25,000 in her insurance settlement, and her damages to the house were $32,000 in total. So Martha can amend her 2016 tax return through Form 1040X and include the $7,000 loss that she sustained to reduce her taxable income and therefore receive a refund to be able to help her right now. So how do we measure the amount of the loss that somebody can take as a result of a casualty? Well, first off, we need to discuss that there are 4 types. You can take a business casualty, a personal investment casualty, a personal casualty, and an employee casualty. And each one is treated differently, and there's a different calculation for each one. So, for a business casualty, if the business asset is completely destroyed, the loss equals basis. However, if the business asset is only partially destroyed, the loss equals the lesser of either the adjusted basis of the property or the difference between the fair market value before and the fair market value after the event. A business casualty loss is a casualty loss deduction for AGI. So let's go through a series of examples that will culminate in an ultimate example at the very end. John's office building caught on fire. He had paid $250,000 for his office originally, and the fair market value of the office had appreciated to $300,000 before the fire. After the fire, the fair market value of the office was only $150,000. So what is John's casualty loss? Well, First, we have to determine whether or not the business asset was completely destroyed. And here, because the value of the office building after the fire was still $150,000 instead of zero, there was not a complete destruction of the property. So then we go to partially destroyed rules. And we take either the lesser of the adjusted basis, which here was $250,000, or the fair market value before, which was $300,000, minus the fair market value after, which was $150,000, resulting in $150,000 as the second alternative. We take the lesser of the two, so his loss for the building was $150,000. This is a 4 AGI deduction. Now let's go on to personal investment casualties. If a personal investment is completely destroyed, the loss equals its basis. If the personal investment, however, is partially destroyed, the loss equals the same as a business loss, the lesser of the adjusted basis of the property, or the difference between the fair market value before and the fair market value after the event. If the casualty loss is attributable to rents or royalties, the deduction is a deduction for AGI. However, if the casualty loss is not attributable to rents or royalties, it is attributable to other investments such as stocks, bonds, or collectibles, it is a deduction from AGI, which is an itemized deduction not subject to the 2% of AGI limitation. We'll talk more about itemized deductions in a later episode. So now let's go over an example. John owned a second office in the office building, and he rented this office to another professional. He paid $250,000 for this office also, and before the fire, the fair market value of the office was $300,000, and after the fire, the fair market value was $200,000. He used part of the rental office to store his Thomas Kincaid collection, which was appreciating in value. He paid $50,000 for the paintings, which were worth $200,000 before they were destroyed. Wow, who knew Thomas Kincaid paintings appreciated that much? So, how much can John claim as a casualty loss? So let's go through the rules. The first is that we have a rental loss. The office that he invested in is a rental, and so we look at, number one, was the rental completely destroyed? No. The rental still had value after the fire, and therefore it was partially destroyed. So we look at the difference between basis, and he paid $250,000 for the property, as well as the other rule, which is the difference between fair market value at time right before the destruction of $300,000 and after the destruction, which was $200,000, resulting in a loss of $100,000. We take the lesser of, so we take the $100,000 for the rental property. And this loss is a 4 AGI deduction. So now let's look at the paintings. Were the paintings a complete loss? And the answer is yes. The paintings were completely destroyed after the fire. So we don't look at the fair market value before and after. We only look at the completely destroyed rule, which is basis, and the basis in the property was $50,000. So he only is able to take a loss of $50,000. Wah, wah. This is a from AGI deduction, and it is a miscellaneous itemized deduction not subject to the 2% limitation. So that's that's at least a nice little added bonus there. All right. So now let's go over personal use casualties. If the property is for personal use and the property is completely or partially destroyed, the loss equals the lesser of the adjusted basis of the property or the difference between the fair market value before and after the event. The loss is then further reduced by $100 per event and 10% of AGI. If the loss is spread between 2 years, however, because of the reasonable prospect of recovery doctrine, the second year is not subject to the $100 reduction per event, but is subject to the 10% of AGI reduction for both years. For disaster areas, adjusted gross income is determined in the year the deduction is claimed, not the year in which the loss occurred. Additionally, personal use casualty gains from insurance and casualty losses with the less than $100 per event reduction are netted together. If they net to a gain, they are treated as a capital gain, and if they net to a loss, they are a deduction from AGI as itemized deductions after subtracting the 10% of AGI rule. If a taxpayer has insurance coverage on personal use property, an insurance claim must be filed to claim a casualty loss. So in summary, you must file an insurance claim, otherwise you get no deduction. To value the loss, you must have an appraisal both before and after the loss, or you get the cost of repairs. But you get the cost of repairs if the repairs are necessary to restore the property to its condition immediately before the casualty. The amount spent for repairs is not excessive. The repairs do not extend beyond the damage suffered, and the value of the property after the repairs does not, as a result of the repairs, exceed the value of the property immediately before the casualty. So let's go over an example to illustrate this. John's personal car was destroyed in the fire as well. For the year, he had adjusted gross income of $150,000. He paid $40,000 for the car, and it was worth $30,000 before the fire and $0 after the fire. How much is his casualty loss? So what we do know with personal casualty losses is that whether it's a complete destruction or a partial destruction, we use the same rule. And that is that we take the lesser of basis, which in this instance is $40,000, or the difference between fair market value before the destruction, which was $30,000 here, reduced by what the value of the property was after the destruction. And in this case, it was $0. That would be $30,000. We take the lesser of the two, which is $30,000. Now we have an additional set of rules, and that is that we must reduce the amount of the casualty loss by $100 per event and 10% of AGI. AGI being $150,000, so 10% of that is $15,000. And so the total amount of the loss of the car is $14,900. And this is a from AGI deduction. Now let's cover employee casualties really quickly. If employee casualties are reimbursed, the casualty loss is deductible for AGI to offset the reimbursement. However, if the employee casualty is not reimbursed, the losses are deductions from AGI as a miscellaneous itemized deduction subject to the 2% of AGI limitation. So for example, poor John, in his car, John had left his work computer from his part-time job. It cost him $3,000 when he originally purchased it and had a fair market value at the time of the fire of $2,000. It was not reimbursed by his employer. Therefore, can he claim a casualty loss? And the answer is yes. Yes, he can. So first we have to figure out what kind of a deduction he can take. Because he is an employee, this is treated like a personal casualty, but it's a little bit different in that he can take it either from or for AGI depending on the circumstances. He did not receive a reimbursement from his employer, and so this would be treated as a from AGI deduction subject to the 2% of AGI. So what's his loss? So we first look at the difference between his basis, which was $3,000, and the fair market value of the loss at the time of the fair market value right before the loss, which was $2,000, and after, which was $0, resulting in a fair market value loss of $2,000. We take the lesser of the two, that would be the $2,000. Therefore, he has a $2,000 miscellaneous itemized deduction subject to the 2% of AGI limitation. So now what happens if there is a casualty gain and a casualty loss? Well, this occurs when you receive more in insurance settlement proceeds than the actual damage. And so the taxpayer must net or offset the personal casualty gain and the personal casualty losses after the application of the $100 reduction or $100 floor. If the gains exceed the losses, the gains and losses are treated as gains and losses from the sale of capital assets, and therefore you receive capital gains. The capital gains and losses are then treated as either short-term gains or long-term gains and losses, depending on how long the taxpayer held each of the assets. Assets held for more than 1 year are treated as long-term assets. In the netting process, the personal casualty and theft gains and losses are not netted with the gains and losses on business and income-producing property. If personal casualty losses exceed personal casualty gains, all gains and losses are treated as ordinary items. The gains and the losses to the extent of the gains are treated as ordinary income and ordinary losses in computing adjusted gross income. The losses in excess of the gains are deducted as itemized deductions to the extent the losses exceed 10% of AGI. So let's go over how you calculate all of this when all of these different casualties are occurring at the same time. First, you add all the income other than casualty income. If multiple casualties, you must compute the business casualties and the personal investment casualties from rent and royalties first because they affect adjusted gross income. If the casualty is a reimbursement to employee expenses, this must also be calculated first if the reimbursement was included in the income. These calculations are necessary because you have to use them to compute adjusted gross income. You then compute the personal investment casualties other than rent and royalty, those associated with miscellaneous itemized deductions not subject to 2% of AGI, and the personal use casualties, which are subject to the $100 reduction and 10% of adjusted gross income deduction, and the unreimbursed employee casualties, which are miscellaneous itemized deductions subject to the 2% of AGI limitation. Then you subtract the greater of the standard deduction or the itemized deductions, including all the casualties. You subtract the personal and dependency exemptions, then you calculate taxable income. So let's go over an overall example to tie it all together. Let's also assume that John is single, and this is for tax year 2017. To show the losses on John's tax return, John has a salary of $400,000. Let's calculate his tax. So to start, we take his salary of $400,000 and we reduce that by the business casualty. So originally we had computed a $150,000 business loss when his business casualty, when his office building was burned and he sustained a partial loss. We then want to take his rental loss of $100,000. This was a result of the rental that he was renting to a professional. We then compute AGI. His AGI is $150,000. Now we take the itemized casualty and theft losses from AGI as itemized deductions. The first is from his computer. So we know that the computer was, we could take a loss of $2,000, but it is subject to a 2% of AGI limitation. 2% of AGI is $3,000, and therefore he does not get to take a loss for the computer as a result of it being treated as a miscellaneous itemized deduction subject to the 2% of AGI limitation. Now, let's take a look at the Thomas Kincaids. The Thomas Kincaids, because they are an investment, are not subject to the 2% of AGI limitation for this miscellaneous itemized deduction. So he gets to take the entire $50,000 loss from the Thomas Kincaids. Now let's look at the car. His personal car, as we had discussed, was worth $30,000 at the time of destruction. It must be reduced by $100 because it is a personal casualty loss, and we have to reduce it by 10% of AGI, which is $15,000, resulting in a loss of $14,900. As a result, the total amount of itemized deductions number of itemized deductions is $64,900. Itemized deductions. We now look at the difference between his itemized deduction of $64,900. We also look at his standard deduction of $6,300. He gets to take the greater of the two, so he should take the itemized deduction of $64,900. So now we take AGI of $150,000 and we subtract that by his itemized deduction and his personal exemption. His personal exemption for this year is $4,050. If he had any dependents or a spouse, he would be able to add those as well. That leaves him with taxable income of $81,050. We then take his marginal tax rate of 30%, which includes both federal and state, multiply that by the $81,050, and that gives rise to tax of $25,530. Alright, so that is everything that you want to know about casualty and theft losses. If you have any questions, feel free to write in the comment box below. And if you want, you can email me personally at centerfortaxstudies@gmail.com. Please subscribe and like this video if you did. Subscribing will give you up-to-date information about tax and how it is applicable to different situations, so be sure to do so. Until next time, thanks so much for watching.